My dear friends, welcome to Rajashekar classes. This is lecture number 29. In this lecture, we will try to understand what is price to book value. The price to book value or P by B ratio, it compares a company's market price per share to its book value per share. What is the formula? Price to book value formula is market price per share by book value per share. Let us try to understand this with simple example. Let me assume market price per share is $50, book value per share is $25, P by B ratio is 50 by 25, which is equal to 2. What it interprets? Interpretation is, this means investors are willing to pay $2 for every $1 of book value. Why? Because your P by B ratio is equal to 2. Therefore, I can say investors are willing to pay $2 for every $1 of book value. What are let me take one more simple example. This is given data. We know how to calculate book value, total assets minus total liabilities. This simple formula you can understand. Here you are getting P by B ratio as a 12. A P by B ratio of 12 means the company's market price is 12 times to its book value. Let us try to understand its interpretation. P by B less than 1 means it is undervalued stock. P by B equal to 1 means fairly valued stock. P by B greater than 1 means overvalued stock. Then what is this P by B less than 1? The stock is trading for less than the company's book value. It indicates the stock might be undervalued. This could mean the market has low expectations for company's future performance, or the company is in distress. What is this P by B equal to 1? The stock is trading exactly at its book value. P by B ratio greater than 1 means the stock is trading above its book value. It indicates market expects the companies to generate higher future returns. There are sector specific P by B ratios. High P by B sectors, technology related sectors, pharma related sectors are the part of high P by B sectors. Low P by B sectors, banks and utilities, they comes under low P by B sectors. When to use P by B ratio? Best for asset heavy industries. It works well for industries like banking, real estate or manufacturing, where assets are key part of the business. Not ideal for certain sectors. May not be useful for technology or service based companies, where intangible assets like intellectual property or brand equity are significant but not reflected in the book value. I can say the limitations are, it does not account for future growth. A low P by B ratio could be a sign of a company in declines. Intangibles, the book value excludes intangible assets like patents, goodwill, and brand value, which can skew the ratio. Industry variations, P by ratios vary significantly by industry, so it's most meaningful when compared to industry peers. It's not useful for companies with intangible assets. That's what I'm saying, does not account for future growth prospects. What are the advantages of P by B ratio? First advantage is simple and easy to understand. The P by B ratio is straightforward to calculate and interpret. It is good for asset intensive industries. It is particularly useful for evaluating companies in asset heavy industries such as manufacturing, real estate, and financials. It helps to identify undervalued stocks. A low P by B ratio may indicate that a stock is undervalued relative to its net assets. It provides margin of safety. For conservative investors, the P by B ratio offers a level of protection. If a company's market value is close to or below its book value, the downside risk sorry maybe the downside, I will repeat, for conservative investors, the P by B ratio offers a level of protections. If company's market value is closer to or below its book value, the downside risk may be lower. Stable compared to earnings based ratios. Unlike metrics like price to earning ratio, P by E ratio, unlike metrics like P by E ratio, that is price to earning ratio, the P by B, price to book value ratio, is less volatile. I can say P by B ratio is a valuable tool for evaluating stock valuation, especially for asset heavy industries. The P by B ratio is helpful tool for value investors, especially when used alongside other metrics like the price to earning ratio and return on equity. Just go through this lecture. Thank you very much.